Dr. Orzag, you may begin.
Thank you very much, Chairman Schumer, Vice Chair Maloney, members of the committee. My testimony this morning covers three principal topics. First, it examines the boom and then bust in the housing market. As Figure 1 shows, the home ownership rate had varied within a narrow range from the 1960s to the mid-1990s, but then increased from about 65% in 1995 to about 69% in 2006. The housing boom stemmed from three main factors. First, low interest rates spurred demand for houses. Second, home buyers' expectations of continued and rapid home price inflation played a central role in propelling prices upward. That is, if people believe that prices will rise, demand for homes increase, which then puts upward pressure on prices. Thus, the expectation of higher prices can become a self-fulfilling prophecy in the short run. As Professor Schiller and others have noted, to the extent that underlying fundamentals are reflected in rental prices, however, the ratio of housing prices to rent may provide insight into the degree to which prices are diverting from underlying fundamentals. That ratio tended to vary within a relatively narrow range between 1975 and 1995 before climbing steeply between 1995 and 2005. A third factor in the housing boom was the plentiful supply of credit, which manifested itself most dramatically in the expansion of the subprime mortgage industry. As has become apparent, the underwriting standards of some originators in that market slipped, especially over the past couple years. Those problems fundamentally stemmed from a failure to provide the right incentives and oversight of originators. In the traditional form of mortgage financing, the originator of the loan also holds the loan in its portfolio and therefore has a very strong incentive to learn about the borrower's ability to repay. By contrast, in the securitized form of mortgage financing, the originator sells the mortgage to a third party and earns a fee for origination, but with little immediate reward for discovering relevant information about the borrower. As a result, the originator may not have adequate incentives to exercise care and discretion in its underwriting unless the ultimate purchaser or the entity providing the securitization carefully structures such incentives. Some borrowers may also not have understood the complex terms of their mortgage. As Ned Gramlich asked in a speech that was delivered on his behalf just before he died, why are the most risky loan products sold to the least sophisticated borrowers? Over the past 2 years, prices have softened and problems in the subprime market in particular have become apparent. Although markets have weakened throughout the country, the increase in foreclosure rates has been concentrated in a few states, which are highlighted in red in the graph. The second major topic of my testimony is the macroeconomic consequences of the problems in the mortgage market. There are four main channels through which problems in the mortgage market can spread to the rest of the economy. First, reduced housing investment. Between 1995 and 2005, investment in residential housing directly contributed an average of 0.3 percentage points per year to economic growth. The slump in residential housing has already weakened the economy, and more weakness in the housing market could constrain growth further by reducing that source of investment. Second, less consumer spending could occur because of a reduction in housing wealth. Lower housing prices reduce housing wealth, which in turn reduces consumer spending. We have estimated the impact of a potential 20% decline in housing prices, and these first two channels, if such a dramatic decrease in housing prices were to occur, would reduce growth over the next 2 years by somewhere between 0.5 and 1.5 percentage points per year. So that would slow the economy significantly, but not tip the economy into recession. There are, however, factors at two other channels. First, contagion in financial markets, the broader spillover or contagion of the subprime mortgage markets into other credit markets, which can impair economic activity through reducing business investment in particular. To date, the increase in risk spreads on other bonds has been concentrated in high-yield bonds, and it is worth noting that the increase that has occurred has returned the pricing of risk even on those bonds to somewhat more normal levels after a period in which they were very, very low. There's been less of an increase in higher rated bonds. A fourth channel that could possibly occur is a decline in consumer and business confidence. which could also slow economic activity as a result. The difficulty is the first two channels, reduced investment in housing and the wealth effect, are easy to quantify. They suggest slowing of the economy but not tipping into recession. The other two channels depend fundamentally on perceptions among investors, businesses, business executives, and consumers. They're therefore harder to pin down because perceptions are, it's like you're trying to predict what other people are predicting. Nonetheless, the best available evidence suggests that while the housing slowdown will slow the economy and the risk of recession is elevated, the most likely scenario is continued economic growth. That, for example, is reflected in the blue chip economic forecasts that were released in early September. Even the bottom 10 forecasts in that survey suggested 2.0% real growth in 2008, and not a single forecaster projected negative growth for the year. So the risk of recession is elevated, but the most likely scenario, at least at this point, seems to be continued economic growth. My testimony also covers policy proposals that could address the financial difficulties in the subprime market, but in the interest of time, I will leave that for your questions. Thank you very much.
Thank you, Dr. Orzag. Dr. Schiller.